There's a new trend in the marketplace that physicians should be made aware of, and those are policies being offered by what are called risk retention groups, or RRGs for short. In 1981, the United States Congress passed what was called the Products Liability Risk Retention Act. And what that allowed was for an insurance company to offer product liability insurance and being only licensed in one state, but selling that insurance policy in all 50 states. 5 years later, in 1986, Congress expanded this under the Liability Risk Retention Act of 1986. Since 1986, insurance companies now can be formed under risk retention groups and offer medical malpractice insurance to doctors in all 50 states while only adhering to the regulations in their domiciliary state. In summary, there are several key differences when you buy a policy with a risk retention group as opposed to a regular admitted insurance carrier in your state. The first one is that there's less regulatory oversight of the forms as well as the rates, meaning that when you buy a policy from a risk retention group insurance company, the Department of Banking and Insurance in the state in which you live in will not be overseeing the policy language, the rates which you're being charged, nor will they do financial examinations on that insurance company in a periodic fashion like they do with a company that's domiciled in your state. The most important difference when you buy a policy from a risk retention group is that in a risk retention group, you are not given the type of protection that you would be from an insurance policy that's purchased from an admitted carrier in the state. Normally, when an admitted insurance company goes out of business, for example in the state of New Jersey, you're afforded $300,000 by the state if that carrier goes out of business. However, if you bought that policy from a risk retention group, you would not be afforded any protection. This concludes our section on risk retention groups. Thank you for joining us.